So I've been investing in the S&P 500 for the last 3 years, but to be honest, I've never really taken it too seriously or actually put that much money into it. But that was until I came across this one simple trick, and it really is so simple that got me excited about this ETF again, and recently I've started putting a lot more money into it. Because I began to realize that if you invest into the S&P 500 using this method, you can actually retire on it much sooner than you think and also have a bit more freedom and free cash in your day-to-day life while you work up to that point of financial retirement. So, in today's quick video, I'm going to show you why I'm investing more into the S&P 500 and one simple little trick I'm going to be using to get more out of this ETF, how it can help me to retire financially much sooner than I thought, and also how this index fund can give me more freedom in my day-to-day life along the way. So, let's get started. Now, the S&P 500 is arguably the most bought and invested instrument in the entire world. It is the most famous ETF, and the index fund itself is usually referred to as the market because it's often seen as such a good representation of the USA economy in a snapshot. And often the performance of the USA can affect markets around the world, so this one grouping of companies is incredibly important for investors and economists. However, the S&P 500 has never really been seen as incredibly sexy, right? It hasn't shown thousands upon thousands of percent gains like Bitcoin or Dogecoin, and it hasn't transformed an entire industry or created self-driving cars and robots and been shot into space like Tesla. No one really says, wow, I invested in the S&P 500 last month and I became a millionaire, right? But at the same time, you probably also haven't heard someone say they lost all of their life savings on the S&P 500 either. Or you haven't heard about it crash like the price of Bitcoin or Dogecoin or even the share price of Tesla at times. So we know what the S&P 500 isn't, but let's talk about what it is. And what it is probably the most reliable investment tool for creating long-term wealth in the world. Many of the top investment specialists, including Warren Buffett, have suggested investing in the S&P 500 as a reliable way to build your wealth, both for beginners and experienced investors.
I think it's the same thing that makes most sense practically all of the time, and that is to consistently buy an S&P 500 low-cost index fund. Keep buying it through thick and thin, and especially through thin.
All you have to do is search for it on any investing platform and zoom out to its max, and the picture tells its own story. And that story is that over the long term, the S&P 500 has only ever gone up. In fact, there is no single point in the history of this index that you could buy in and not make money over a 20-year period. Even if you bought right before the biggest of crashes, you would still make money over time. And if you invested during those crashes, you would be doing great right now. The way it works is this index is a bundle of the 500 biggest companies in the USA, and if any company goes bankrupt or underperforms to where it falls out of that top 500 spot, it gets removed and it's replaced by the next big company. So you are always investing in big companies in the world's largest economy, and because of that combination, you have a good recipe for making money and returns, especially over the long term. It also pays a dividend of typically around 1%, which is not huge for passive income. But recently I heard about a little rule that changed a whole lot. And it's called the 4% rule. And the 4% rule is a rule invented by the financial advisor called William Bengen in the 1990s, and that's why it's also called the Bengen Rule. The 4% rule is a retirement strategy that suggests that withdrawing 4% of your initial retirement portfolio each year, adjusted for inflation, is a way to create a steady income stream that can meet your financial needs all the way throughout retirement. Now, that doesn't mean you need to be 65. It means that if your income meets your expenses, you don't have to work and you can financially retire and live your life doing whatever will make you happy. And for me, that has always meant creating a passive income investment portfolio that can meet my financial needs through dividends. But now with this 4% rule, it means that instead of having to wait until I have millions and millions in my S&P 500 and then withdrawing from it until it's empty, by following this rule, I can withdraw from it in a sustainable way, allowing me to withdraw an income each year while still maintaining my asset sum and having it still grow and ideally not only keep up with inflation, but outpace it. because the data shows that the average return of the S&P 500 over its history is 10.7%. So essentially, it means every year you sell 4% of your ETF as a manual dividend to use for your expenses, and with the growth of the index, it should replenish that 4% and still even grow your portfolio by 6% each year on average. Now, here is the exciting part, is that along with its 1% dividend, you will then be withdrawing 5% in dividends a year from the S&P 500, which is actually more than some of my investments that I have bought strictly for passive income. And on top of that, you are getting a world-class index with solid and proven returns over decades and much lower risk than most individual companies. And it means that if you just invest 20 times your expenses, you can financially retire. And that's it. It's so simple. But I didn't say it was easy because it isn't. Otherwise, everybody would do it and no one would have to work. But it is possible and could just allow you to financially retire much sooner than you would have thought with just annuities or pension plans. But the next part is that you can also do whatever you want with this 5% because investing is there to suit your needs. And if all you're looking for is a way to get some extra income for a holiday each year, then brilliant. Invest in the S&P 500 and every year withdraw your 4% and get paid your 1% dividend, and you've got 5% that grows with the markets every year for the rest of your life to take a holiday with you and your family. Or if you just want to grow your wealth and have a bit of money on the side for a new watch or new shoes or a nice anniversary meal, whatever it is, you can still withdraw your 5% every year, and on top of that have your capital sum remain there and continue to grow over the long term. Or if you're like me, you can build it up and put it towards your retire early passive income pool. And best of all of this, because your capital sum should remain as it is and in fact keep growing every year, this is something you can also pass down to your kids and possibly grandkids and so on. Now, I have to mention, as we all know, that the market will fluctuate and go up and down in the short or medium term. In the last 5 years, you can see some years it went up and some years it went down, and we never know which year that is going to be. But even with those ups and downs, the S&P 500 still grew an average of around 17% a year, and each year it grows, the amount of those 5% payments grows along with it. So for me, I'm going to be ramping up my buying of the S&P 500 and continuing to pound cost average into this index fund, growing my holdings, growing my returns, and growing the value of my 4% withdrawal and my 1% dividend so that I can grow my capital wealth and my passive income at the same time. But that's just me. Obviously, your investment will grow faster without withdrawals, and maybe you want to do it that way so you reach your financial goals faster. Like I said, investing is there to serve you, and it can be whatever you want it to be. But just remember, this isn't financial advice. I'm just here to share some information, some inspiration, and some of my journey. So guys, that is it for today's episode. I hope you gained something valuable out of it, and remember to like the video and subscribe if you haven't already, and I will see you guys next time, as always, on Casual Cash. Cheers.